Okay, gang, hopefully you can hear me. We're going to jump in here to module or practice one of our 2.0 pathway. How these will go is we will do sections of them. So there'll be, smaller bits. I think we might get through 1.1 and 1.2 today. We'll have to see, but in essence, I mean, this is a soup to nuts. So we're gonna talk today. Will be fairly basic, but it's meant to make sure that you have an understanding of what is the field that you're playing in, and who are the players, and how can you make decisions around that. So with that, let's jump in and rock and roll. Okay, this is part of 20 different, larger sessions that are part of a framework to help deliver you to the market in a way that you have the ability to assess what's going on, build your approach, know how to augment your approach, know how to fix things. It's really to give you the competence that, you would have if you were on a desk, trained on a desk, and hopefully saves you hours and years potentially that you would have been spending doing the DIY thing, just kind of, rocking and rolling. So here's our objective in this block of sessions, and that is to see market activity as driven by predictable human behavior, and that we're seeing. Hang on a second, getting real quick. Do me a favor, and if you haven't yet, just make sure that you've muted your mic so that we don't get that bleed. Would be wonderful. But we're looking to see all behavior as human behavior, and profiling essentially is a way that we can organize that information and we can qualify that behavior. So if we can make quality statements about that behavior, then that allows us to make better decisions, and that's the whole objective. Now, one of the chief questions in this session that we're going to talk about is what type of information drives your participation in markets. So what is it that you look at, think about, informs, yes, I should click a button, yes, I should take action here. What are those things, and are they things that actually matter and actually can be predictive and move forward, or are they a little bit more of a snake oil issue? There is a challenge that we're trying to overcome in this, and that is essentially, how do I cut through noise? Because there is so much noise when it comes to markets. What's one of the great things about the world that we're in right now? So much information, right? There's so much that's accessible. Some of it's really good. It's exceedingly challenging to figure out how to know what's actionable and what's not. And so, this is meant to try to help you lean on something that would actually be helpful. What's the risk? If you don't have a fundamental understanding of how markets work and what you can lean on, then it really does kind of put you in this perpetual everything works kind of situation. And you may actually, I've seen this before, where a developing trader comes across a framework that actually would help them. They don't really know how to sort that yet. So it ends up being not as helpful as you might. The value of whatever that input is gets lost, and that's really too bad. This is meant to be able to go, hey, I know why this matters, and I know why this doesn't matter, so that what's the chief outcome is that when you approach the market as a behaviorist, so already kind of tipping our hat a little bit in terms of where we're going, that you're positioned to adapt to anything and everything. Because there are parts of markets that change, and there are parts of markets that don't. How do you know what to adapt to, and how do you know what to stay convicted around? Okay, we want to stay away from dogmatism, because there are things that we have to adapt to, and we want to have conviction about, yes, this matters. The market really cares about this. Markets care about this. They don't so much care about this specifically within my time frame, and then ultimately we have to roll that up into decisions. Right, we have to roll this up in decisions. So, if there was a key takeaway for this block of sessions, again, it is that you'd see all market activity as driven by human behavior, and human behavior specifically is predictable. It's predictable. And if you're like, oh man, it's not predictable, it's all random, ask your friends how predictable you are in any environment. You'll find that we all are fairly predictable. People who know us, they're like, oh yeah, like Josh shows up this way, he does this, and we can use that in the broader market. Okay, so first stop on the bus is looking at market analysis as a predictor. Okay, so what do I mean by that? Historically and currently, when someone goes to look at a market, you can look at it through a couple different lenses. So you can look at it fundamentally, you can look at it technically, you can look at it from a quantitative basis. And so I'm going to kind of walk through just examples of some of these, just to make sure that you have an understanding, because this has a bearing on everything we do and what information that we bring in and believe matters. All right. So from first spot, what's fundamental analysis? What is that? How do I read into that? What's helpful with that? Well, let's look at inputs that someone who's looking at fundamental analysis might look at. Okay. So I've got Yahoo Finance picked up here, and if you've ever looked at Yahoo Finance, Bloomberg terminals, I think FinViz, I've got FinViz also up here. There are fundamentals, specifically when someone's trading a fundamental approach to a market, they're looking at what's the undergirding financials of this company. And so, with respect to NVIDIA, I want to highlight, somebody who's a fundamental trader is going to look at NVIDIA and say, hey, I really like what's happening in NVIDIA. And they may look at, a number of different things as a real low-hanging fruit. They could just look at net income for common stock, right? So they could go, let me get my pen to work here. All right, so this should work now. If I just look at the net income over the last several years and look at how that number has really continued to increase. So the fundamental story of NVIDIA is one that is pretty bullish. Right? So if you're a fundamental approach, if you're looking at that from a fundamental perspective, you're not looking at from a bearish perspective. I mean, even just looking at the basic earnings per share, or even a diluted earnings per share, see how that's increased year after year after year, right? So somebody who's looking at a fundamental approach is going to use that. Now, there are, there's benefits to this. One, it seems pretty simple. Got a bullish case on NVIDIA, right? Rock and roll. That makes a lot of sense. We can look at things like, hey, is there supply and demand questions around something? Is there continued demand? Do I hear demand around NVIDIA stock or their chips, right? So I can look at that and say, as long as that narrative holds, rock and roll. And then I just really want to make sure that there's growth within this asset vehicle, whether it's a stock, whether it's a commodity, whatever it is that we're looking at. But it's really about the story, and the story is tied to like the fundamental economic and financial factors within that thing. Okay. Now, those are some benefits. What are some drawbacks when it comes to like having a playbook trade? One is as markets are always trying to price in information, and even a stock is a future. Okay. So when a stock is first released, like an IPO to the market, that is people are not buying the current value of the company. They're buying the future value of the company. They paid everybody who had done the work up till then. So you're only buying an IPO if you believe that it's going to have future growth beyond that. And so what is hard to understand sometimes is like this old adage, buy the rumor, sell the news. How much of whatever that future economic or financial performance is already priced in to this market? We're not going to spend a lot of time talking about it here, but there's a concept of efficient market hypothesis. The idea is that all markets get to a place of equilibrium where they get rid of edge. And they get rid of edge because there's essentially they get to a perfect information and then it's out. The investor tries to be in front of that. And that's just really, really hard to know, when is it priced in or not. most self-directed investors tend to be on the I'm going to buy the news, sell the rumor kind of scenario, and that just comes from a fundamental lack of understanding about how these vehicles are priced and the participants around them. Okay, so do we look at fundamental analysis as part of what we do? Well, kind of, and we'll talk more about how we weave that in. The second kind of key area is technical analysis, right? So a technical analyst is someone who says, you know what, I can't really get my arms around all this data. And I also understand that some of it's priced in, some of it's not, and so I'm just going to not try to play in that space, and I'm going to look at the fact that, hey, these things operate in patterns. We're, as humans, we are pattern recognition vehicles or pattern recognizing creatures, and so we can look at a chart and we go, oh man, there's a pattern there. How can I leverage that? And there are tools around that have to do with technical insights. So let's see, let me get to a spot here. So that's all performance. No. We're going to get looking over here. FinViz, here's a platform that people will look at this based on technical analysis, and they'll look at, oh, it's below this moving average or that moving average. Some of these are self-fulfilling prophecies. If you're looking at a stock, for example, everybody wants to know where the daily 200-day moving average is. Where are we on a 50-day moving average? Where are we on a 20-day moving average? Or is there some trend line that is in place or broken? And the assumption is that this is meaningful in terms of my approach to the market. And we can all do this, right? Like we can grab a chart and we can start plotting, and all of a sudden things start to make a lot of sense. We're like, oh yeah, we're in an upward channel here. So as long as we stay in that channel, I want to be long the Russell. It's in a way to organize information, and it seems to have more insight as opposed to looking at fundamental analysis, because it seems to be a little bit in front of that. We can see patterns. It helps us reduce noise, which is great, but there are some drawbacks. One of those is, time frame impact. Like, what time frame matters for what I'm trying to look at? You can end up having so much stuff on your chart from a technical perspective, and the belief that the other challenge is that a technical analysis is not predictive. So can it describe what I'm seeing? Like, can I qualify what's happening? Like if we go look at this Russell chart, can I suggest that the Russell is in an upward channel here? Yes. But what does that mean? How do I actually turn that into a trade idea? And does anybody else care? Right? Are the participants that I want to lean on, does it really matter at all what these prices are? And that becomes exceedingly challenging. And people will often migrate from a fundamental perspective first, and then they'll go to a technical perspective, and then they go, okay, well, I need a little bit more rigor to this to help me time some of the technical analysis. And so that's where we go to the third area, and that's quantitative analysis. So quantitative analysis is where we're looking at large batches of data, and we're making decisions based on some form of metric. What's the historical return of this thing relative to its 3-month average? How many sigma is it away from that? We're using really large data sets to try to organize information and make decisions, trying to be predictive based on, well, this is what's happened in the past, and this is within a large block of data. So, given a nod to the idea that, oh yeah, we actually do have some things that are predictable based on how things have gone in the past, when these certain variables are in play, then that could lead to insightful information. Okay, so what are some benefits around that? One is you get large data sets, so it is thinking about lots of samples. Why is that? Like, why can that be better than a technical perspective? A technical perspective can say, it's very, very easy for us as humans to start narrowing in on some behavior that we've seen in the short term. So as humans, we're really good at anecdotal data, but the plural of anecdote is not data. So the plural of your experience is not data. I can give you an example. If we look at the pandemic that we weathered over the last 5 years, if you encountered someone who said, "Hey, I know this person, and they had this bad reaction to the vaccine, and so all the vaccines are bad." Okay, that's an anecdotal experience. Like, that is not an untrue statement that person had a bad experience. However, is that descriptive of what reality is? No. Well, how do we know? Because we had the largest data set of people within clinical trials in human history, and the variances of adverse effects were at percentages significantly lower than typical vaccines that are released. And how did that happen? Because we had really, for the first time in human history, I think, because everybody was freaked out, we had researchers who were just broadly sharing their data sets, especially higher ed, like peer-reviewed data that was just being freely shared. There was stuff originally in Italy that was being shared. There was stuff in Mexico. Like, all the higher ed researchers were sharing data, and like, that's not typical. So it's this massive data set. Well, when you have hundreds of thousands of people getting a vaccine, are you going to have adverse effects? Absolutely you are. Is it representative of what the reality is in the safety? No, because that's what a quantitative perspective says, right? And a quantitative perspective over time will do better for you than an anecdotal one. Okay, it's hard. It's really hard to get our heads around that, because we often can't touch the data. We have to kind of trust, and that's where it gets into, like, well, do I even trust the data that's there? That's a discussion for another time. But what a quantitative analyst attempts to do is they say, hey, I don't want the last 5 instances this happened. I want, like, what's a large data set say? It's like if I flip a coin. Okay, if I flip a coin 10 times, what can happen? I can have 10 times that coin comes up heads. Why is that not a great perspective to take around that? Is because if I do it 1,000 times, it'll be 50-50 every time. The rule of large numbers will give me a different picture of reality, and that's the one I want to lean on. Not the, oh yeah, well, I had this time, and it's 10 times it's heads, so that means it's always going to turn heads. No, that would not be wise. Okay, so it sets market expectations. It uses large data sets. What are some drawbacks? It's not at the right edge of the chart, and it's also one of those things that, like, how do I know where to price the trade? Okay, yeah. So based on the last 100 times that this has happened, or 1,000 times that this has happened, here's been the expectation. Well, how do I price that? How do I put any kind of structure around that? That's really, really challenging. And if you look at even like macro quant funds, I mean, they have some pretty low win rates, because they have to have in these large, wide areas that they're looking to be active, and becomes very challenging. So, of those number of approaches, so we have quantitative, fundamental, technical, quantitative analysis. The question then becomes, like, which approach gives us the most consistent predictive edge? Like, which one gives us the most predictive, consistent edge? And the reality is that none of them do. Like, they are all pieces that can give us qualitative statements. They can help us arrange information, but they are not in and of themselves predictive of what's going to happen next. And that becomes the significant drawback. Okay, so as you think about your approach to markets, I mean, that would be a question that I would have for you is like, okay, if I'm making a decision, what's driving that decision, and does that input actually offer for me something that's going to help me make good decisions and predict what's going to happen next or not? It doesn't mean that those things aren't helpful, but the difference between something being predictive and descriptive are a totally different thing. Okay, so that is session 1.1, thinking about market analysis as a predictor. In the fold of us thinking about human behavior predicting future market activity. Okay, so let's. I'm going to stop this.